Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. And let's get you up to speed with an hour to go in the trading day. And you're looking at a bit of a rally across the board. The Dow up just around 148 points off the highs of the session. The S&P up just about 1%. The Nasdaq, the leader of the three major averages here. Some weak economic data out this morning. The sluggish business activity, also decline in mortgage demand, really upping some of the bets out there that the Fed might be done raising rates. And when you take a look at that sector action, technology and communication services leading today's gains ahead of that very important Nvidia earnings report after the bell this afternoon. Also, decline in yields is helping investor sentiment. When we take a look at the 10-year yield, pulling back a bit today, off just about 12 basis points at 421.
Well, today is the day. Nvidia's second quarter earnings setting the stage in what's expected to be a key test for the AI hype. The stock surging over 200% so far this year, thanks to that AI craze throughout the first half of the year. And here to outline the sky-high expectations for the chip maker, we have Yahoo Finance's Inez Ferre. Inez?
Yeah, Diane, I will tell you, today is really a day of anticipation for the market. For analysts, one analyst from JP Morgan, Stuart Humphrey, saying that the Nvidia anticipation is, quote unquote, killing us. And basically saying in a note to investors, while I know there's a pushback because people worry too much, too fast isn't sustainable, he says, even still, I'm positive on the stock and believe it will trade higher after the number. So the question is, what will happen after Nvidia reports its quarterly results? More importantly, what are those quarterly results and what will be the guidance? We also recently had a note from Baird's Tristan Guerra basically saying we expect a significant beat for Nvidia's fiscal second quarter, raising their price target on the stock. UBS raised its price target on the stock as well from 475 to 540, writing Nvidia is quite literally serving as kingmaker as a huge wave of capital is chasing AI. It is all about AI. And guys, really, when the last quarterly result was announced back in May, you saw that the stock absolutely surged on that absolutely killing guidance that they gave. And really what investors are expecting today is, will we have that same reaction? There are 52 buys on the stock, 6 hold, and 1 lone sell, with the average price target on the street being $520. The question is, what's going to happen with this stock, and will it also lift other tech stocks like it did after it reported its last quarterly results?
And that is what every analyst, every investor is trying to figure out at this point. You talk about the importance of this report, the broader market implications. There was even one analyst out this morning making some connection between Nvidia's results tonight and what that could mean for the Fed. What was the point there?
Yeah, that's right. This is from Ben Emmons. He's over at New Edge Wealth. He's a fixed income expert. And basically what he was saying is that Nvidia has become sort of the bellwether when it comes to AI. And if you think about AI, you think about more productivity. And if you think about more productivity, you think about that leading to growth. So to some extent, that also could impact interest rates expectations going forward. He's making this connection between how well Nvidia does, what this means for the broader market, and what the Fed's goal is and what the Fed would perhaps do. So he's got that chart right there that you see, that as Nvidia's earnings per share estimates are going higher, so is that probability of another rate hike, guys.
Well, interesting correlation there. All eyes indeed on Nvidia today. Also interesting to note, Inez, that you pull out that there's one lone sell, one contrarian out there for us to watch out for, see what happens today. Inez Ferre, thanks.
Thanks.
A pullback in yield today, helping investor sentiment as some weak economic data is boosting speculation that maybe the Fed is going to hold off on future rate hikes. The moves coming ahead of Fed Chair Jay Powell's speech at Jackson Hole on Friday. BlackRock Global Fixed Income Chief Investment Officer Rick Reeder joined Yahoo Finance this morning to discuss what he thinks is ahead for the Fed.
Will they go one more 25? Potentially, but I think we're basically at the end of this hiking cycle, and I think we should be. You look at some of the retailer dynamics, and all of a sudden people have gotten on the economy's in better shape, which I've always argued the U.S. economy will surprise people. But now I actually think it's moderating a little bit, and so I think the Fed can take its foot off the brake, as it were. Just let these high rates marinate through the system for a bit of time.
All right, we want to bring in Will Rind, Granite Shares founder and CEO. Will, you just heard what Rick Reeder of BlackRock had to say about what he thinks is ahead for the Fed, and the moves today coming on the heels of two economic prints that pointed to a slowing or weaker economy. What do you think is appropriate or what the Fed should do at this point?
I agree with the sentiment that we may see another 25 basis points, but I don't think we're going to see anything actually coming out of this meeting. And again, nor should we. I think that we're at the end of this particular cycle. My concern has been that, for some time, that I think the rates have gone too far too quickly. And we're starting to see the ramifications of that in different parts of the economy. But certainly in terms of mortgage applications, new mortgage applications, what's going on in the commercial real estate sector, and even now the employment numbers that have just been revised down today. So I don't think that there's really a huge case to continue to expand this tightening cycle at this stage. And I think that given there hasn't been that much data coming out, probably the most likely outcome is to do nothing at all at this stage.
So if the Fed does something, actually, and it does continue its current tightening cycle, let's say it does raise another 25 bips at the September meeting, what is your expectation for what that does to the economy?
I don't think another 25 basis points is going to make much of a difference. I mean, my argument, like I said, is that rates are too high where they are already. So adding another 25 bips or so only makes that situation worse, and I think only exacerbates the problems that inevitably are coming down the road, especially in anything to do with interest rates, but particularly in the housing market, where we see both in the commercial and in the residential part of the market a lot of now constraint because of the impact of higher rates starting to really emerge.
Well, let's talk about one of the big events, or the big event, at least today, and that's Nvidia's earnings. We're going to get those after the bell. This stock has been on a tear since the start of the year. We're talking about gains of just about 220%. In terms of what this means for the broader market, how much is riding on tonight's report?
A lot. I mean, I think really that's kind of what it boils down to, is that the stock market, this year, this has been the year of Nvidia, and I may add Tesla as well, as two stocks that have kind of carried the market to this point. And, I think that is really the crucial thing. Nvidia is a great company. Regardless of what happens tonight, Nvidia will continue to be a great company. And I think that there's a huge amount of promise, not just from AI, which clearly everybody's talking about, but the softer gaming revenue that they saw last quarter. I think that could come back, and we can see a revision there, as well as the data center business, which continues to go from strength to strength. But I think the real key to this is kind of where we end up at the end of the year. And I think Nvidia, beating here is really a key to the S&P or the Nasdaq, depending on which one you favor, if finishing higher at the year end.
So let's play a little bit of devil's advocate. We know the expectations are high, and the expectations to beat the high expectations are high. But let's say Nvidia fails to perform as many expect. What does that do to broader market sentiment?
I think it will come off. But I don't think it's going to be that badly affected, because I think people just have to look at where those revenues have come from. So, up considerably on where they were last year. I mean, the revenues just exploded for that company. So if expectations are not exactly met or met, somewhat, I think, again, there's a little bit of shine that comes off. But I don't think that ultimately it's really that much of a big deal, because providing that company is still posting strong growth, which I highly expect it to do, the story is still intact, I think, for a number of years to come.
Well, when we talk about, we're getting Nvidia's report, and this coming at the end of second quarter earnings season, when you take a look at the beat rate, it's been impressive. Yes, we know the bar has been lowered a couple of times heading into some of these reports, but what has been, I guess, your takeaway from the results that we've gotten during the second quarter, and how that sets us up for the second half of the year?
I think, again, to the narrative of the earnings have been much better than people expected. I think that's something that's caught people by surprise the first quarter, and is catching people again the second quarter. And obviously, we've had a big rally in the market so far this year, which I think has caught a lot of people by surprise. And certainly, there's a lot of cash sitting on the sidelines, as we know, that perhaps has been failed to deploy in this environment where so many people have been bearish about an imminent collapse that just hasn't materialized. So, I always like to bring it back to the fundamentals. And when you look at the stock market, ultimately it should be about earnings. And so companies beating earnings expectations that should be what the stock market is about. And that should be the key metric that drives performance on. And so the fact that we've had really still great earnings for the most part coming out shows just how resilient the economy is still. And for the bears, it's been a tough place because this imminent recession that they've been predicting for so long now just hasn't materialized.
And so, well, I want to talk about the single stock ETFs, the business you're in. Granite Shares, as just to let our audience know, this week launched 4 new leveraged single stock ETFs to help investors play big tech names like Nvidia and AMD and Tesla. So talk to us about these new single stock ETFs and who's the audience for this? Is this a short-term trader or does a long-term investor get in on something like this?
Yeah, so we just launched 4 yesterday, but that adds to an existing suite of 6. And these products have now really just gone past their 1-year anniversary, the oldest ones in terms of being in the US. It's a new US category for the ETF industry. But as the name suggests, simply provide leverage, or if they're a short strategy, inverse leverage to popular stocks like Nvidia. So the standout one for us has been NVDL, which is our 1.5 times leveraged Nvidia. And that is just trading like crazy and has really sort of captured the zeitgeist around Nvidia and those that are wanting a bit of extra amplification on their Nvidia returns. But the 2 that we launched yesterday, we have a pair of products linked to Tesla. So the highest leveraged Tesla ETF now in the market, which is TSLR, that's 1.75 times leveraged. Previously, the highest one was 1.5. TSDD, which is the short, so 1.5 times short Tesla. And then an inverse, it's not leveraged, but an inverse AMD, which again is tapping into the demand for semiconductors and AI type stocks as AMDS. And then the last one, an inverse leverage 1.5 times on Nvidia itself, and that's NVD. So that again captures the short side of our NVDL, which has been really the standout star of the show this year. But to your point about your audience, it's a really large audience because you have, all of your kind of professional trading firms that you can think of, your big names, right down to clearly retail investors. Because it's an ETF, you can buy this in your brokerage account and hold it just like any other stock. So assuming that you're, provisioned or you're permissioned, I should say, for active trading, that these products really serve that audience who's looking to either get some amplification or magnification on returns for the long side, and then ability to go short, which is so difficult to do for even professional investors.
All right. Well, Ryan, always great to get your perspective. You're CEO of Granite Shares and founder as well. Thanks.
Thank you.
From single stock ETFs to individual stocks, let's check in on some of today's top trending tickers. Foot Locker shares skidding, I should say, after the retailer reported an almost 10% year-over-year drop in revenue in its second quarter, missing analyst expectations. The company also slashed its full-year guidance amid a softening in the consumer. You're looking at that stock down nearly 30%. And Shauna, things that stood out to me in terms of their earnings release is just them talking about the consumer and citing a tough consumer backdrop, price-sensitive consumers, consumer softness, that repetitiveness that we've heard from some retailers about the difficulties that the consumer is starting to face. And so we see that playing out in terms of their reduction in their guidance. Now seeing full-year comp sales falling in a range of 9 to 10%. That's worse than they were originally forecast, 7.5 to 9%, right?
Yeah, and it's the second time this year that we've seen Foot Locker lower their guidance, and that really speaks to how challenging this space is prices. And Diane, you were just talking about the softening consumer certainly has been a theme so far these last 2 weeks. We've heard from more and more retailers. When it comes to Foot Locker's business, certainly it's challenging on many levels. We know the new CEO there, Mary Dillon, has really been trying to turn around this company. Cowen was out with a note following these results saying that deeper restructuring is needed, and they expect some of this pressure that we've seen on this business to last beyond the holiday season, certainly painting a challenging, a tough picture here for this retail company, given some of those macroeconomic concerns that we've been talking about, and also inventory levels. That, of course, is still an issue for a name like Foot Locker. Jeffrey's pointing that out, just the fact that inventory levels are still relatively high, and that could, of course, keep some of the continue to pressure margins just a bit when we talk about promotional activity and what's necessary to clear some of that backlog. And that, I think, just speaks to the fact that it's going to be a very, very challenging couple of quarters here potentially for Foot Locker. And we're also seeing some of that fear creep into some of its rivals. A Nike stock was also under pressure earlier today. We talk about the fact that this is a larger story than just one specific name.
It is definitely expected to have a knock-on effect to Nike, especially due to the type of inventory that Foot Locker carries. A lot of its revenue comes from Nike. Another thing I did, I was like, oh, let me do a search for shrink and see if it shows up in their earnings release. It's there, like other companies has cited that issue. So it's an issue for Foot Locker as well. It's clearly not the largest issue that it has at play, but it's a problem for that retailer, just like it is for other retailers.
It is, yep, theft. One of the things I had mentioned a couple of times in the earnings call as to why some of the profits have been hurting so much. All right, let's take a look at another stock that's under pressure today, and that's Peloton. Shares falling just about 23%. Costs for its seat recall were significantly higher than what the company had initially anticipated. And they also reported a decline in subscribers for its fiscal fourth quarter. Peloton now sees revenue in the range of $500 to $600 million for the current quarter. That's well below the street's expectations. 750,000 requests for a replacement seat. They have fulfilled 340,000 of those requests so far, so just below, just around half of that, nearly half of that. But this recall leading to an additional $40 million in costs for Peloton, coming at a time that's certainly not ideal for this company. They've been struggling with falling demand, struggling to really gain subscribers. We actually saw a decline in subscribers this time around. They need to do a little bit more here to right this ship. And I think people are asking on the street exactly what that looks like and whether or not maybe they could be an acquisition target here down the line.
Yeah, I mean, I know there's been a lot of talk, at least over the past year, possibly even a little longer if we look back, about the potential to be acquired by, say, I know previously there have been talk about maybe Amazon acquiring Peloton. It needs someone to, kind of scoop it up because of where it is. I mean, it's quite a fall from grace for this company that once traded at more than $100 a share at its high. And I mean, it's trading at $5 now. And, it shows they really underestimated the impact of this recall, the fallout from the recall. I mean, McCarthy saying that an estimated 15 to 20,000 of its 2+ million members pausing their subscriptions in Q4 based on the receipt. Could you imagine being on the bike and the seat just breaks, So, I mean, they've had this problem with recalls before. Under their old leadership, they dug their heels in at refusing to recall initially. And now they're realizing they have to do it, but also still underestimating how much of an issue that is.
Yeah, and certainly a huge issue when you take into account 750,000 people are asking for their replacement, $40 million in costs. It's all adding up, and it's certainly going to be a challenging road.
Yeah, indeed. All right, we're just getting started here on Yahoo Finance Live. Coming up, investors bracing for results from Nvidia after the bell today. We'll have everything you need to know both ahead and after the report. Plus, one analyst is initiating coverage on 8 stocks today. And with football season kicking off soon, we're putting together a starting lineup of companies on the other side. And Abercrombie Fitch shares soaring today as earnings smashed estimates. CEO Fran Horowitz speaks with Yahoo Finance's Brian Sozzi about the state of the retailer later in the show. Stay tuned. More Yahoo Finance on the other side.
The man who led a failed insurrection against Russian President Vladimir Putin has been listed as a passenger aboard a plane that crashed today in Russia. Russian state media saying that all 10 passengers aboard the plane has died. But there does not appear to be independent confirmation that Yevgeny Prigozhin was actually on the jet. The plane was heading from Moscow to St. Petersburg and crashed just north of Russia's capital city. Russian media say that an investigation is underway. The crash coming just months after Prigozhin, the head of a mercenary force called the Wagner Group, led a brief rebellion against Russia's military. That action back in June came to an end after a compromise was reached and Putin offered the group immunity.
Well, stocks edging higher as investors look to Nvidia's earnings for signs on whether the market can move past the downturn in recent weeks. But how does the yield from stocks stack up against cash? Here with the details is Yahoo Finance's Jared Blickery. Professor Jared, take it away.
Hi there. Well, in preparation for tomorrow's morning brief, I'm writing about, guess what, anything not related to Nvidia. So I'm looking at cash or the 13-week T-bill yield. And let's take a look at a 2-year chart of what you can invest in the government, basically zero-day maturity. You can see how it's gone, especially that big rise last year when the Fed got really hawkish and started raising rates aggressively. You can see it's now sitting at 5.30%. Meanwhile, if you look at the earnings yield as the S&P 500, which is actually the inverse of the PE ratio, it's standing at about 4.8%. So in April of this year, we did have a crossover where cash or money market funds or 3-month government bills are yielding more than the equivalent amount of money in stocks. And I have this chart prepared here. This actually goes all the way back to 1950, and this shows the difference between what stocks are yielding, the S&P 500 earnings yield, minus that 3-month Treasury bill rate. And here it is going negative of this year. Last time it was negative, you have to go back to 2001, and that was coming from the opposite side here. It was in 1996, I believe, that it first started going negative, and we know that there was a huge increase in especially stock prices, tech stock prices in the 1990s. So let me go back. This has important implications for how investors are thinking about their money, because we had an entire generation where people were used to low interest rates, not used to the fact that they could get a living interest rate out of their money market funds. And so the investing implications now are the calculus is a little bit different when we see stocks taking a dip. The thinking before was there is no alternative. You have to keep plowing money back into stocks, especially into some of those lower yielding, high growth initiatives. And now the calculus is different. So all of this is going to change. There will be another inversion back toward normalcy when the Fed eventually cuts rates. Of course, we don't know exactly when that is. But for now, things are a little bit different.
All right. Thank you, Jared. Appreciate it.
All right, well, stocks are higher in the final hours of trading as investors await a pivotal earnings report from Nvidia after the close. The results will be a big test for the AI frenzy that has swept across Wall Street this year. Joining us now is Scott Devitt, Wedbush Securities Managing Director of Equity Research. Scott, it's good to see you. Now, you're initiating coverage on 8 stocks today. We wanted to do it a bit differently since football season is right around the corner. So let's put together your starting lineup, stocks that you've given an outperform rating to, starting with 2 names that you say are well positioned for AI growth, Alphabet and Meta. We're putting 30 seconds on the clock. Give us your bull case for both.
Thanks for having me. So first on Alphabet, Performance Max continues Alphabet's long history of ad innovation helps to take the company beyond cookie attribution. That's the first point. Second, AI integration and search will be additive to the user experience. Third, YouTube's a dominant business. It's as big as Netflix in revenue. YouTube TV is by far the best TV experience, and this is underappreciated within the Alphabet stock. And finally, 4, AI will be beneficial for all the hyperscalers, including Google's compute engine. And second on Meta, I was going to say on Meta, if I could.
Go ahead.
So they've had issues on the heels of Apple privacy changes, and that's been addressed by innovations such as Advantage Plus that help to close the gap created by the loss in attribution. Second, AI is going to drive the next cycle of connectivity for Meta. And finally, Instagram should cross over 50% of revenue by 2025. And I know I exceeded the 30-second limit, but I feel
but that's
like
partly
the
that.
ability to.
Part of that was
with
my
two stocks,
fault.
yeah.
I think we should have given you a little bit more time there, Scott.
I think
that was
so
a tall
too.
task.
And plus, like, you had a preamble, so they did put they held the clock for a little bit before starting the clock. I was like, oh, that's fair, because he's like, thank you for having me.
15-yard penalty.
Yes, exactly. No, we won't set you back 10 yards. 10 yards, that's all. So whatever. You still have time. But I just want to quickly ask you, though, just, the risks, though, for, say, Alphabet. Are there any concerns to your case when you think about, for instance, they have some antitrust issues coming up in September? They have a trial to face then.
All these companies have antitrust issues, and yet they're all great, innovative companies that provide better consumer experiences along the way. So that battle between government and the dominance that's created by consumer centricity is always an interesting one. I'm kind of more on the side that the companies win in the end and the governments back away or do things that aren't prohibitive to overall growth in the franchises. The other thing with Alphabet, to keep in mind is that generative AI search results are more expensive. So as the user experience improves in search, that the costs may go up. But my view on that is as search improves, then volume improves, and that offsets the incremental cost of running the higher cost generative AI search results.
Okay, I forced you to play and analyze. All right, Scott, back to game. You're initiating coverage on Amazon too. An outperform rating with a price target of $180. The stock currently trading a little over 135 bucks a share. This time, 20 seconds on the clock.
Oh my gosh.
What's your pitch? Maybe we'll give you a little Go.
Okay, so Amazon was forced to build the peak pandemic. It's taken a bit of time to grow into that infrastructure. We're finally there. Growth's improving, products arriving faster, margins are improving. Also, it's becoming a solid third in the ad market, and finally, AWS has stabilized. So we're seeing the numbers and the narrative on Amazon in the very early stages of shifting back to what this company's always become, which is dominant.
Nailed it.
Scott, there has been, I'm going to follow up there, because when we're talking about AWS, that certainly has been the story. When we talk about Amazon, there's been lots of talk just about the slowing growth in AWS. Clearly, that's not a new story, a new headline out there for anybody. But has some of those fears then been overblown just in terms of what this is going to mean for Amazon in the future?
It's interesting with each of these mega cap consumer technology companies, you have the reality of the business, what the numbers are saying at that very moment, and the narrative that's built on that. And Amazon's the company that's been put through the ringer more recently for two reasons. One is this retail business was built up to peak because it had to be. So when the business underperformed post-peak because demand for its services were declining because consumers were preferring to go outside and to purchase services over goods, then all of a sudden it was as if Amazon did something wrong. They didn't do anything wrong. They just had to build the business to a peak that was for once in a 100-year pandemic. So now they're growing back into it. Products are getting to customers faster. Top line is recovering. Margins are expanding. And oh, by the way, AWS, which was also slowing because the consumption of its customers was slowing because the economy was slowing, is now beginning to stabilize. So as the fundamentals start to improve, we think that narrative kind of shifts back to what Amazon always has been, which is dominant in retail, very well positioned number 3 in advertising, and a very strong number 1 in web services.
All right, let's stick with e-commerce here. You've got an outperform rating on Shopify, a $62 price target. This is a stock that's also done significantly well since the start of the year, up over 60%. What's the catalyst going forward?
So Shopify invested in a logistics business to offer services that more directly competed with Amazon for its customers. It failed miserably in that area and it moved on. So it's back to being a capital light, high margin model offering connections to third-party logistics offerings for its merchants. And in addition, and probably most importantly, it just opened up its Shop Pay service to merchants outside of the Shopify network. And in doing that, I apologize, there was some background noise, so I'm gonna take an extra 5 seconds.
That's right, take it back.
The Shop Pay offering has now been opened in the way that PayPal was opened in the early days from eBay to all merchants. And we think this is a very critical kind of moment of adoption for its payment services that's gonna allow Shop Pay to be much more competitive in the payments ecosystem. And that's gonna be a catalyst for the stock.
All right, we're going to put some more time on the clock for another one that we want to look at from your list. We're looking at Pinterest. You've got a neutral rating with a $30 price target. We're going to put 20 seconds on the clock to tell us what the case is, why you're neutral on Pinterest now.
So it should benefit from the integration of ad placement technology, such as a deal that it recently has done with Amazon. The challenge that we have with it is the addressable market. How big can this company be over time? Having said that, so one good, one bad, it's a very strong management team and the product itself is very good. So we like the stock, there's just not enough to get it over the hurdle to be an outperform rating.
There you go, Scott, getting it in all under 20 seconds. I was going to say, next time you come on, if we play this again, we got to give you a little bit more time, but still a very, very impressive go. Scott Devitt of Wedbush, thanks so much. We look forward to having you back.
Thank you. Thanks. Bye-bye.
All right, coming up, the Hollywood studios are trying to put pressure on the writers to try to end the ongoing strike. We've got the latest details when we come back. Hollywood studios releasing the details of their latest offer to screenwriters in a bid to end the ongoing strike. The new offer, well, it includes higher pay and protections against AI. Yahoo Finance's Alexandra Canal has the latest details for us. Ali, are we getting any closer to a deal?
Well, it's an interesting tactic by the studios to release this proposal publicly. They're doing this to put some pressure on the Guild, which actually denied the proposal in a meeting late last night. The two sides meeting face-to-face for the first time in a long time. We had some pretty prominent executives there, like Disney CEO Bob Iger, Netflix co-CEO Ted Sarandos, WBD CEO David Zaslav. But the Guild slammed the meetup in a follow-up email to members saying, quote, "This wasn't a meeting to make a deal. This was a meeting to get us to cave." So some pretty fighting words there. They essentially said that this deal didn't even come close to addressing all of their concerns. They still want a mandatory number of writers to be staffed on every show, in addition to bonuses based on how popular a show is on a streaming service. But this is what you're seeing on your screen now, is what the studios did offer. And from their perspective, they believe that they really hit all the main points that the writers were asking for. We see higher compensation, increases to streaming residuals, further protections around AI, a guaranteed minimum length of employment, and more transparency around viewership data so writers can actually understand the popularity of their work. And just to get even more specific here, the studio said the proposed wage increase would be a compounded 13% jump over the 3-year contract. And that would actually be the highest increase for the WGA in 13 years. And then on the streaming residual side, that would jump by 22%. So they think they came up with a fair deal. Writers say no. It's a lose-lose situation. That's what I'm hearing from analysts right now. I mean, writers are out of work. Some, they have livelihoods that are just on holds right now. And then on the studio side, they're strapped for cash. They're bleeding money. Streaming profitability is still a major issue. And we're going to eventually hit a point where we're going to run out of content. So at some point, some people are even predicting in 2024, so it could go on for that long.
Wow, that would be long.
The pain on both sides is just going to be too much. So it's just, how long can both sides hold out here?
That's a good question. And apparently the writers are also asking for a cut of the rewards when it comes to revenue. Could this be a sticking point, especially as analysts predict Netflix is about to have a huge cash injection?
Yeah, I mean, Netflix is doing really well with some of their revenue initiatives, like the crackdown on password sharing, the ad-supported tier. I do think that's going to be a sticking point. They want a cut. If a show is doing really well on a streaming service and bringing in subscribers, the writers are saying they deserve a piece at least of that pie. But again, the streamers are really hesitant to set a precedent here. The studios are, because if they sign something, if they, commit to giving a cut to the writers and then they're not able to make money in the end, that's going to be an issue. So it's not just coming up with a contract for today, it's thinking about where the industry is going to be in the next 5-10 years. I mean, the last writer strike in 2007, no one would have ever predicted the explosion of streaming that we're seeing today. So it's a really challenging environment to try and think of a deal and come up with a way that both sides can sort of reach this compromise. But clearly the writers right now believe that they have the upper hand.
And it sounds like it could be maybe possibly a while until we do get at any sort of deal, right? Allie, thanks.
Thanks.
All right, it's been called the summer of strikes, and while UPS averted a walkout, America's largest automakers are in the middle of a contract battle, and it may not have a happy ending. Members of the United Auto Workers Union are in the process of voting to authorize a strike when their current contract expires on September 14th. And the economic fallout could be massive. An estimate from the Anderson Economic Group says a 10-day stoppage could cost $5 billion. Joining us now is Tyler Thiel, Anderson Economic Group Vice President. So paint the picture for us about what this potential economic fallout could be. So, of course, we're talking about lost wages. What other areas of the economy are we expected to be impacted?
Certainly. So lost wages are, of course, the largest numerical value loss that we look at when we assess an economic impact of this nature. However, right now, compared to, for example, the UAW strike in 2019, the economy and the auto industry looks different than it did 4 years ago. Sales environment is different, prices are different, inventory is different. And so we see in this strike potential the opportunity for stronger and greater losses to dealers and consumers, on top of course, company losses to Stellantis, GM, and Ford.
So Tyler, let's break that down a little bit further. You talk about the fact that it could impact the automakers, consumers, and also dealers. Let's start specifically with consumers, because a lot of people are asking, hey, what could this mean for me if I'm going out to buy a car? What does that look like? And I guess the timeline of that, because a lot of it, I would think, depends on how long this strike goes on for, potentially.
Certainly. So back in 2019, if you'll recall, the GM strike lasted 42 days. That caused, if you look back at the seasonally adjusted data, a single quarter recession in the state of Michigan because the auto industry is so strongly represented. But back then, we had about 5 times the vehicle inventory that we do today. Granted, that ranges widely from vehicle to vehicle, brand to brand. However, right now, on average, we're hovering at around 55 days inventory. And so that's certainly not enough to withstand a very long strike.
And given what the historical data shows you, what does your data show you about expectations for how long a strike could last this time around?
Well, you know, the talks and the rhetoric leading up to this strike have been different as well. In the past, we've seen the UAW strategy be to target only one of the big 3 OEMs in Detroit. And we certainly saw that 4 years ago with the GM strike. However, in this case, I read recently with record profits, employees would like to see record-breaking contracts. And if they have the motivation to strike at all 3 of our big 3 OEMs, it would just be a completely different picture, a much stronger impact in the economy. And when we add up a total economic impact, for example, it is not just GM plus Ford plus Stellantis. The industry multiplier required grows at that rate because there is a stronger impact to the industry as a whole.
Tyler, the approach to the talks this time around with President Shawn Fain at the helm of UAW, how has that differed when we talk about the approach and the potential outcome with all 3 striking, with the UAW striking against all 3 of the automakers versus what has happened in the past? What do you attribute that to? And I guess how big of a deal or how much more that loss could be as a result?
Certainly. Well, the way he has built it up could almost set the stage for disappointment if there is not a strike at all 3. And I don't mean to have that be taken the wrong way, but when you almost guarantee that you're going to strike at all 3, doing anything less could disappoint his members.
And I want to ask you, Tyler, is the potential that this may end up being much ado about nothing and that there isn't a strike ultimately, that they come to the table and come to some kind of resolution?
That would certainly be ideal if they can have productive negotiations between now and the middle of September and come up with contracts that make the workers feel like they are being appropriately paid, but also, really importantly for consumers and auto dealers across the country, contracts that are actually sustainable for the OEMs so that we can see a stable automotive industry, especially right now while we're in the midst of electric vehicle transition, very high interest rates on car loans. We just can't potentially withstand the long strike with the resilience that we did 4 years ago today.
Well, we will certainly be watching this space. We've talked a lot about strikes this summer. We will see what comes to pass when it comes to UAW and the deadline coming up middle of September. Thanks so much, Tyler Thiel of Anderson Economic Group.
Thank you.
All right. Coming up, shares of Toll Brothers rising after the home builder boosted its sales outlook on new home demand. We're diving into the earnings call on the other side. Stay with us. Luxury home builders Toll Brothers trading up more than 3.5% after reporting stronger than expected quarterly orders. The company also raising sales expectations amid the housing shortage. CEO Doug Yearley calling out the state of the country's housing stock in the earnings call, which he says was a key driver behind the home builders' busy quarter. Yahoo Finance's Danny Romero has more. Danny?
Yeah, Diane, Toll Brothers CEO Doug Yearley didn't shy away from calling out the housing inventory in the resale market lousy. This comes as the home builder plans to deliver over 9,000 homes by the end of the year, with a price tag between of $1.05 million to $1.15 million. But what are the factors weighing in to this bullish call? Well, it's a combination of strong demand and their focus on spec homes. That is a development without a specific buyer in mind. Toll delivered over 2,500 homes with a price tag of over $1 million. Remember, Toll touts itself as an affordable luxury home builder. They sell specs at different stages of construction to give buyers the opportunity to finish their home with their preferences. And so Toll is also really known to offer incentives like rate buy down, so lowering those mortgage rates, which looks really attractive when mortgage rates are hovering over that 7%. But something that on the call that the company pointed out is that that's really attracting spec buyers, the rate buy downs. Another thing to point out is who's scooping up these homes. They're the all cash buyers. They made up 25% of the sales in the third quarter. But overall, what does this say about the housing market? Well, that the newly built homes market is really looking strong, resilient, and the government data today really showed that to be true.
Yeah, certainly. It's all about inventory. The fact that existing homes, simply there is not a lot of those homes on the market. When we talk about the inventory picture improving, or even when the home builders are going to be able to get more homes on the market, what does that timeline look like?
Shauna, builders are going to continue to fill that gap as long as the resale market remains muted. And so we're going to see a steady influx of new homes come to the market. But to give you some perspective, the total number of homes, single family homes under construction is higher than it was pre-pandemic. And last year, it took over 9 months to finish one single family home. And experts say that more inventory will come to the market over the next year.
Oh, well, hopefully so for a lot of people. I mean, that's a big issue in the housing market. Danny Romero, thank you.
Companies are struggling to raise funding. A new study from Deloitte found that 88% of private companies are having a tough time accessing capital, leaving businesses strapped for cash. Here with more on how executives are navigating this very challenging environment is Wolf Tone, U.S. and global leader of Deloitte Private. Wolf, it's good to see you. So 88% of private companies saying that they simply are having a very tough time getting the money that they need. You spoke with about 100 executives of those private companies. What did you learn just about the biggest barriers to getting that funding?
Thanks for having me on. The biggest barriers are not a huge surprise. Rising interest rates are certainly a challenge. The concern of a recession looming in the future, challenges with supply chain remain on a lot of executives' minds, as well as just the fact that they don't have collateral on their balance sheet to really get the debt that they need.
And so then what are you hearing about like expectations for what this can do to the VC space? Like, do we see, kind of consolidation happening there?
The report really highlighted one thing. It showed that over 50% or nearly 50% of the businesses that we talked with said that their valuations were decreasing. And what's interesting about that 50%, the vast majority of them were going to consider an acquisition or being an acquisition target in the next 6 months. And so when you take that to the next level, you say there may be an opportunity, or we may see an increase in M&A activity as we round out 23 and moving into 24.
Wolf, is this similar across the board? Or when you take a look at these private companies that are having tough time accessing capital, their valuations are decreasing. Are you seeing it maybe more prominently in some of those smaller names, smaller companies?
There is no doubt there is a differentiation. I'll call it the tale of two cities. And those two cities are the companies that have revenue under 200 million and those that have revenue above 200 million. We didn't get into industry or sector, but just focusing on revenue size. Those organizations with revenue less than 200 million were facing bigger challenges. The barriers to getting the capital that they needed and so desperately needed for growth seem to be much higher than those with higher revenue and presumably better balance sheets.
And then what came out in terms of what the focus is for the balance of the year in terms of what they're prioritizing? Is it, investment in technology? Is there going to be an expansion of AI? What was kind of leading the way in terms of priorities?
There's no doubt there were three things, regardless of the company's size, that organizations prioritized. It was around talent, technology, and productivity. And the fact is that when you even look at productivity, that there's probably ebbs and flows of both talent and technology in that answer. And so as companies look to address digital demand, as they look to consider cyber risk, as they assess what AI means to that organization, the need for technology upgrades and investments is required.
Wolf, is there optimism that this landscape is going to change at all, that it's going to improve for some of these companies that are looking to get access to funding?
One of the things that you will see in private companies, and we believe this is a thread amongst nearly every private organization, is resiliency. This concept of investing for the long term. They're not measured on quarterly earnings. You have investors. I'll take for an example, a lot of U.S. companies are family-run businesses, are multi-generational. They have been through economic cycles. They've seen both the good and the bad. And with that, they also know that every cycle there's going to be a good side to the end of it. And so therefore, as they think about their investments, as they think about the future, they're willing to make an investment, recognizing that they may not measure success on a quarter or an annual basis. They may measure success in a decade or a generational viewpoint.
And Wolf, where are these companies going to turn with the issues with regard to, VC capital being just harder to come by now? What did you hear in terms of your study, in terms of where these companies will be raising capital from?
The first source that most organizations said that they will turn to would be equity. And when we talk about equity, let's think of it in two ways. One, existing shareholders or owners. The number two would be bringing in outside capital. And so then that's the primary base. The secondary base is bank capital or bank funds. And with that comes the natural challenges of interest, increasing interest expense and things like that. And then the third is that we're seeing more companies start to address or look at, are there opportunities for joint ventures or mergers with organizations of similar kind or like opportunities, and really trying to optimize those such that they have got the capital necessary such they can grow.
Wolf Tone, Vice Chair of Deloitte Private, thanks so much.
Thank you.
Well, coming up, we're ringing the closing bell on Wall Street. It's still looking at gains across the board. The Dow up 160 points. S&P and Nasdaq leading the way. The Nasdaq up just about 1.5%. We'll be right back.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
And that's the closing bell on Wall Street, checking in on where things closed for the day. All three of the major averages in the green ahead of highly anticipated Nvidia report any minute now. We're expecting that after the bell. Take a look at the Dow closing up just around 185 points. S&P up over 1%, back above 4,400. And the Nasdaq, the leader today, up 1.6%. Technology and communication services among the outperformers in today's market action. All right, let's take a look at some of those individual movers. First up on the flip side, Foot Locker shares sinking into the red, closing off 28%. The company is slashing its annual guidance for the second time. Foot Locker also announcing it will suspend its cash dividends beyond a recently approved payout slated for October. The bad news keeps piling up here, Diane, for Foot Locker. A very, very challenging couple of quarters possibly ahead. Theft, markdowns, hurting profits, sales falling nearly 10%, pausing their cash dividend. I think investors are really questioning what it's going to take to turn around this business.
It's a good question. I mean, we saw Foot Locker previously guide lower for their expectations for sales, for comps, and now expecting an even bigger, pardon the pun, shoe to drop there. Sorry, it just came out. I mean, they slashed their full year outlook for earnings down to a range of $1.30 to $1.50. They previously guided for between $2 and $2.25, $2.25 there. So, just the call outs also about the price sensitive consumer. Foot Locker CEO Mary Dillon saying that in the company's earnings release. I mean, and just the worries about the consumer and the discretionary dollars and where they're spending them. And right now, Foot Locker feeling the effect of people choosing to spend their dollars on experiences, and they still haven't seen a strength with back to school season. Like some retailers have seen some strength there, but some, again, all the retailers in general that we've seen have, though, talked about worries about the consumer. Some are managing to avert those issues, but Foot Locker not doing so well here. All right, another stock we're looking at, Williams-Sonoma, out with an earnings beat. The company also raises its operating margin outlook for the year. The stock finishing up more than 13%, about 13.5% on the day. This boost in margin guidance offsetting the company's reduction in its revenue outlook. So, its margins look good. They were stronger than what was expected. They may have had some sales declines, but, Williams-Sonoma held up. If people don't remember some of their brands, they also own Pottery Barn. I think West Elm is in their belt, too. So it looks like management has done well in terms of managing their margins. Shauna.
Yeah, they've done okay. It's certainly a challenging time here for Williams-Sonoma. You take into account some of their brand names that you were just mentioning there. West Elm there was weakness during the quarter. Sales off 20.8%. That was much more than the street was looking for or expecting. They were expecting a drop of 13%. Also, Pottery Barn, comp sales there declining over 10%. The estimate was for a drop of just about 5%. So yes, the focus here and the reason why we're seeing gains during the day today was because of the fact that it did boost its full year operating margin forecast. That was enough to excite the street, especially since investors were bracing for a cut. But it is still a very challenging couple of months likely ahead for Williams-Sonoma and also a number of the names within that sector. And Baird out saying that they do have a strong balance sheet, which does provide a capital allocation optionality. So it enables them to weather what's likely going to be a tough couple of months, but still consumers pulling back on discretionary spending. We've seen that pretty much across the board from the retailers. It's going to set up some of these retailers to have a tough couple of months.
Yeah.
All right, let's take a look at Netflix getting a boost after data from research firm Antenna showing that U.S. subscriber additions in July remaining high. This coming after an initial surge in subscribers following the start of the password sharing crackdown back in May. We're looking at gains of just about 3.5%, the fourth day in a row that we've seen Netflix close the day higher. Oppenheimer reaffirming its outperform rating on the stock, $515 price target. They call out two tailwinds here, paid sharing and also advertising initiatives. Those two initiatives, they see boosting revenue by 40% for the fiscal year 2023 compared to what we saw back in 2022.
Yeah, it's really interesting to see that, just the expectation and Netflix doing better than expected in terms of the implementation of that password crackdown, not seeing the churn that we expected, and not seeing just general churn in terms of streamers. I mean, Netflix continues to be the leader in that respect. Even if you think back to once upon a time, they had that quote, love is sharing a password. Apparently it's not now. But again, Oppenheimer pointing out just that they expect to see this revenue increase, and that the drivers are being underappreciated by investors today, definitely being appreciated by investors in terms of where the share price is right now.
Yep, up just about 3.5%. All right, well, let's talk about the big news after hours, and that's Nvidia. We're gearing up to get its second quarter results. There's a heck of a lot riding on these numbers. Yahoo Finance's Dan Halley here with what we could expect, and expectations are high. We saw a number of Wall Street analysts boosting their targets ahead of these results.
Yeah, expectations are very high. Nvidia kind of did this to themselves when they announced their guidance would be for $11 billion versus what expectations were of $7.2 billion. And so now we're going to see if this all pays off, if the AI hype cycle really is panning out. Sure, Microsoft, Google, Meta, they all mentioned it. They're all part of that. But the reality is that NVIDIA is basically the driver for all of this at the moment. So let's just go over what the expectations are for the quarter. For revenue, we're looking at $11.04 billion. That's compared to $6.7 billion in Q2 last year. We're looking at $2.07 for adjusted EPS compared to 52 cents last year. Data center revenue, $7.98 billion expected compared to $3.81 billion last year. And then gaming revenue of $2.38 billion compared to $2.04 billion in Q2 last year. Again, all of this coming from the big AI push. Part of the problem for NVIDIA, though, is that they don't necessarily have TSMC able to push out as many things, platforms as they potentially need. So there's a few things that I'm going to be looking forward to during the actual earnings call, and that includes the projections for next quarter. Right now, the estimates from Wall Street are for $12.51 billion. That's up from $5.93 billion last year. Massive difference, right? The reason being because last year we had seen the gaming portion of their business kind of get its knees cut out from it because so many people had went out and bought their devices during the pandemic and they just didn't need them anymore. And so gaming just fell off a cliff. Now, that doesn't mean that this jump isn't also powered by AI. It certainly would be if it hits those expectations. Again, we're talking like stratospheric now. Yeah. The other thing we're looking at is the state of the chip market. What does this say for the likes of Intel, AMD, Qualcomm, Broadcom, all these different companies that are working in the chip space? And then finally, how is NVIDIA staying ahead of the competition? A lot of brands are looking at building their own chips specifically because they just need them now. And so there are other brands. Look, NVIDIA did managed to build a moat around itself with its software and its AI prowess as far as the hardware goes, but that doesn't mean that other companies can't also do that. So Intel, AMD, just kind of getting at their heels, seeing how fast they can get closer. We had Qualcomm now talking about getting in, and by the way, when it comes to ARM, they're basically saying, hey, we're AI too, and it's like, well, cool, yeah, but not like NVIDIA. So we'll have to see.
So obviously, we've talked about this, NVIDIA being far and away the leader when it comes to AI and the chip space there. One of the questions that we heard this week is not so much the demand issue, right? The demand is there for NVIDIA, but there is concern about meeting the potential, like just supply, right? So who stands to benefit as kind of number two and number three behind NVIDIA from your point of view?
Yeah, I mean, look, if AMD can manage to get itself deeper into the server space, that would be huge for them. If Intel can manage to get its GPU offerings deeper in to the server space, then them as well. But they're just so, NVIDIA, they being NVIDIA, are just so far ahead of the competition right now, it's difficult to tell who the second and third bananas would be. I think, Qualcomm is a company that is increasingly pitching itself as AI, though they still make the vast majority of their money from mobile processors. So it's really difficult to tell at this point. But it is worth pointing out again that the hyperscalers, the Microsofts, the Amazons, the Metas, the Googles, even Tesla, not a hyperscale company as far as cloud goes, but they're all working on their own AI chips, right? So they're still definitely working with Nvidia, but they're using their own chips as a potential stopgap, and then maybe as time goes on, a cost savings, because Nvidia can basically charge an arm and a leg for whatever they want at this point.
Yeah, well, we'll say that's down the line. All the focus now is on Nvidia being the leader, at least here for the short term. Again, shares up 220% since the start of the year, moving just to the upside here in extended trading ahead of these results. Dan, thanks. Well, coming up, we are checking in on some of the top trending stories of the day. Ali Canal, Josh Schaefer, what do you guys have on deck?
Hi, Shauna. Well, fall is in the air, and so is the scent of something very familiar. Do you smell that, Josh? Do you smell it?
Smells a little bit like pumpkin.
Mm-hmm.
We're going to try the new Starbucks pumpkin spice latte next. Stay with us. Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Brooke DePalma. We're breaking down some of the top trending stories today that we've had our eyes on. And guys, I've had my eyes on Peloton shares all day today, touching an all-time low at one point during the trading session, closing down over 20%. Oof. This comes after quarterly earnings this morning. Peloton warning that they will not make as much money as the street had hoped next quarter, and also that a recall in bikes impacted their business a little bit more than they expected. So they had a recall on one of the seats from the original bikes, and they said they got 750,000 requests on that recall, significantly more than they had expected. That led to a wider than expected loss for the current quarter. And then when you take a look at that sales guidance, they're now guiding for $580 million to $600 million in the next quarter. The street had actually been hoping for closer to $650 million. So as subscribers are starting to come down a little bit for the first time at Peloton, they're seeing that subscriber number come down, revenue coming into question as well now too.
Yeah, it just feels like blow after blow for Peloton, right? And they're trying to do other things. They're trying to partner with businesses. Hopefully that is a way to invigorate some subscriber growth and therefore revenue growth. But to me, I always think back to the pandemic era and how popular Peloton was at that time. And, you know, in some ways, I feel like Peloton is a victim of its own success, right? You had a lot of subscribers at the front. Now, as economies are opening up, people want to go do workout classes in person. Perhaps that's coming down. But at the same time, there has been critical mistakes that this company has made, especially in terms of some of that guidance.
And I do want to point out something the executive said on the call was they said, I don't know how many more of these unwelcome surprises there are in our future, but it seems to me that we have been getting closer to the end of that story that we are at the beginning of. So I really think Peloton really just looking to push to the end here, to push to where they're going to turn around the business. And, you know, they brought in the executive, longtime Spotify exec, who literally said that he came out of his retirement to build back this business and is all head in on this. But another part, you know, speaking of all those people that got Pelotons during the pandemic. Well, now that rental business, now that used bike business is doing really well for them. They did note that on the call that they have a rental business that now totals 48,000 subscribers. In addition to that, the launch of their Peloton certified refurbished business now totaled 6.5 thousand sales in Q4. And so really looking to perhaps take what they gained during the pandemic and reutilize it here?
Yeah, it seems like there's just a couple different things that they're also doing as well, right? When you take a look at the business partnerships that we've talked about, and then also they're trying to get on college campuses now. There was that announcement yesterday that they're going to be out with the University of Michigan now, helping athletes get on the Peloton is essentially where that's going to go. You're going to see the Peloton
That's smart.
on the side of the
Especially
football
if you have
field.
Football stars, like college sports.
So like the bikes that the players, ride on the sidelines for at least the University of Michigan are going to be Pelotons. I think that's actually very interesting brand placement when you think about the other brands that the University of Michigan has. The University of Michigan is sponsored by Jordan Brand. They probably drink Gatorade on the side. Like those are brands that then translate well to the Gen Z audience that's watching college football, right? And if you're trying to get in with the younger audience, I think it's kind of an interesting play.
Yeah, you can even have like guest trainers
on the bike.
But
doing
classes.
Of, I was gonna say like Kendall Toole, Allie Love. These are names that I'm sure you guys have heard as well. They really have become household names during the pandemic, and they've stuck around. Robin Arzon, she has 2 children's book underway. But another point that you pointed out earlier, Josh, is this niche market that Peloton continues to have. And you mentioned Simeon's call earlier today of them really embracing this niche market of people who are working out at home, people who really are feeding and following these influencers and feel that sort of sense of belonging to them. Right now, they're still trying to think big picture. They're not really focusing in on that niche market.
Right. Well, I think what Simeon at BMO was pointing out is basically as you start to see subscribers maybe come down a little bit and maybe that number doesn't keep going up forever and maybe it never reverts back, is how do you make more money out of the people that you have? And so how do you get them to take more classes or find a way to make more money just off of them and create more money from the current market that you have is also a fine way to grow your business. And maybe that's Peloton's path forward.
Every subscriber-based business is looking for that engagement. That is the number one thing. But
sticking around.
While Peloton might not be as cool anymore, there is one thing that's cool, and that's LinkedIn. You heard it here first, folks. This was interesting. There was a story out about how LinkedIn is cool again, especially as we're seeing this reckoning of sorts across social media, across the board. We had the rebrand of Twitter to X, which did cause a lot of users to leave the platform. We had Threads debut, a lot of subscribers off the start, but not as much engagement. And it seems like during this upheaval in this space, people are looking at LinkedIn as a reliable social media platform that they could post their work accomplishments, update people on where they're at. I deleted Facebook about a year ago, and I will say LinkedIn has been my Facebook replacement. I'm on it. multiple times a day.
Right.
Yeah.
I keep tabs on all my peeps.
I think LinkedIn, for me now, has become what Twitter was when Twitter was easier to actually just look at people you follow. And if you use Twitter to get information, I think that's what LinkedIn is. There's a lot of people that post interesting threads on LinkedIn.
Oh yeah, I get
and
news
blog
off
posts,
LinkedIn.
right? And so I
Family
think
updates.
I think a lot of
Yeah,
people are
people
starting to
buying
use LinkedIn
houses.
that way. I mean, this one stat that was just fascinating to me: users shared 41% more content on the network this spring than in 2021.
Wow.
And
I mean,
LinkedIn's
that's
an
crazy.
old company. That level of growth is pretty impressive.
Yeah.
Right. And also, too, I did want to note this stat. LinkedIn's revenue rose to $15 billion in Microsoft's most recent fiscal quarter. That's almost triple 5 years ago. So it really just goes to show the momentum that LinkedIn is showing. And also, too, it sounds sort of cheesy, but LinkedIn has really been sort of a thought leadership place where influencers and executives are really sharing their, best quotes, their best Monday mantras. And I follow Sarah Blakely. She's CEO of Spanx. I also follow a few Target executives who really share good life hacks about how to go about your work life, your personal life, and balance it all. And I just find myself like you, scrolling through it, looking for that sort of advice.
And with that, there's also come the satire side of it too. There's one guy I follow, his name's Jack Rains. He does, I think it's the Young Money Substack is what he does, and he sort of does finance jokes to some extent, right? And he sort of makes fun of some of the stuff that we talk about here and things like that. And one of his posts last week that I absolutely loved, he was talking about how the weekend is now the time to work because you can get ahead. Ooh, he's like, go out on Wednesday night and show up to work a little bit later Thursday because no one works on Saturday and Sunday, so then you can get ahead of everyone. Sort of
but I feel like
making
that
a joke on some of the founder advice and stuff you see, but it's funny, right? And once you start getting funny and educational, then you're having a real social media and real, and like a real discourse on social media.
And you could follow now. I'm sure he has a following, a subscriber
over
base.
30,000 followers on LinkedIn.
Crazy.
He has,
and I feel like that's
he's basically
something
posting
that
jokes. It's awesome.
He probably would have posted on X, on Twitter formerly, and so them sort of gaining this momentum from it and really exemplifying just day-to-day life as opposed to what, say, our parents' LinkedIn used to be, where it's just strictly about work. I remember at college it was a huge push because no one really wanted to jump on, but now I feel like there's young people who are really looking to build their portfolio on it.
Also tangible advice and tangible resources. Like there's LinkedIn people that are employed by the company that can help you with your resume, that can help you get certifications. I mean, you can actually gain things by using the platform consistently. So I think there's a lot of wins here for LinkedIn.
Yeah. Absolutely.
I'm bullish on LinkedIn.
So Microsoft,
bearish Facebook, bullish LinkedIn.
Bearish Facebook, bullish LinkedIn.
I love it. Well, speaking of gaining share, Starbucks is back with their pumpkin spice latte for the 20th year in a row. Can you believe it? The Starbucks pumpkin spice latte debuted back in 2003. It's now the 20th anniversary, and it's not just the pumpkin spice latte anymore. The pumpkin cream cold brew is returning for the 5th year alongside a new creation debuting from customers' hacks. It's called the Iced Pumpkin Cream Chai Latte. Say that 3 times fast. It has chai tea. It's topped with pumpkin cream cold foam and pumpkin spice nuts. Now, the offerings have expanded beyond just pumpkin. They now have an apple crisp oatmeal macchiato and a shaken espresso version of that. Since cold sales really have boomed, 75% of total beverage sales last quarter were cold. And we got an inside look. They do debut on Thursday, August 24th, but we got a first taste. Cheers. So, Allie, what do you have right now?
I have the chai tea.
Okay, first.
My goodness, this is sweet.
Right. Ooh. I did get an inside taste on that, and it is very
sweet.
It's
sweet, man.
It's flavorful.
Yeah.
It has a lot going on.
It's really good.
Now, this is a customer hack, and this just goes to show the companies that are really,
fun.
weighing in on listening to customers, weighing in on social media, and building on that. I mean,
so customers actually
requested this last year because, as we talked about before, those modifiers, that pumpkin cream cold brew, people adding that on top of their drink is something that they saw, and so they decided to add it to the menu.
And I think it's smart to expand beyond the coffee drinkers because the chai tea is very popular. Starbucks, and a lot of people use it. How about you? I know you're not a pumpkin fan.
This is my first pumpkin spice latte.
First one ever.
It took him 20 years.
We got a first timer.
All right, what's the review?
I'm kind of in on it.
Ooh.
Yeah, I drink black coffee.
I'm shocked.
I drink black coffee strictly.
Oh my God.
You're like the espresso king.
Yeah, I really like espresso. I like Starbucks
pumpkin.
espresso. I like the Pike Place coffee.
Okay.
I like the cold brew.
Wow,
But
I'm shocked.
I would mix this in maybe every now and then. Maybe like a weekend coffee.
And that's
Something fun.
exactly what they're looking for after 20 years, looking for new customers to keep on coming. But other ones, other names have joined in. We're thinking Dunkin', we're thinking Wendy's potentially getting in on the buzz. So lots more to come. The PSL season has only begun.
All right, well, one more cheers to pumpkin season upon us. But earnings season is still rolling on. On the other side of this break, we'll have Nvidia earnings coming up. Don't go anywhere just yet.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Nvidia out with its second quarter results, and look at that. We're looking at gains of just about 6.5% here in extended trading. Another huge report here from the chip maker. A lot of this gain that we're seeing in after hours is because of that massive forecast that they're giving here for third quarter revenue, 16 billion plus or minus 2%. The estimate was for 12.5 billion. We take a look at the numbers for its second quarter revenue coming in better than expected, 13.5 billion. The estimate was for just over 11 billion. That's up 101% on a year-over-year basis. Record data center revenue of 10.32 billion. The estimate was for 7.98 billion. That's up 171% from a year ago. Gaming revenue, $2.5 billion, beating the street's expectations. Adjusted EPS also coming in better than expected, $2.70. Nvidia also approving an additional $25 billion in share buybacks. Let's break it all down. For that, we want to bring in Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, good to see you here. An extremely strong report from Nvidia. What do you think of it? Your first take?
No, it was fantastic. I mean, clearly as far as the quarter is concerned, it was all about the data center side of things. You kind of broke down the numbers extremely well, and you kind of look at where data center landed at about 10.3 billion. That compares to about 4.3 billion just in the prior quarter. And, to your point, grew north of 170%. Our view was it would come in at around 8 billion. So, north of 25% higher than what we anticipated on that side of things. I think also, on the gaming side of things, it also looked really good. Grew about 22% year over year. We were looking for growth of about 15%. That was the first quarter gaming actually saw growth in 5 quarters. So it was good to see kind of a return to year over year growth on that side of things, clearly due to some easy comps on that side. And then, of course, in terms of the guidance, I mean, absolutely fantastic. Looking at a $16 billion run rate now, you're talking about a company that's now annualized kind of running at a revenue clip of north of 60 billion, right? So it's just absolutely astonishing how quickly the revenue trajectory of this company has grown here over the last 2 to 3 quarters.
So, Angelo, when you think about NVIDIA, it's kind of like I keep thinking kind of these Olympic analogies. It's like the Usain Bolt in this space. You've had a $500 price target on this. It's clearly going to eclipse that based on where it is in after hours trading. How much further do you see this stock running?
I think that's a good question. I mean, I think kind of what everyone's kind of thinking about these days is, NVIDIA is clearly kind of entrenched in a highly cyclical industry. I will say this, there are parts of NVIDIA's kind of guidance and revenue trajectory right now that is cyclically oriented, and then there are parts that are where you've kind of got a real structural shift and change taking place. And just kind of looking in terms of their GPU business, right? I mean, you look at an AI server today, you've got about 8 GPU sockets that you can kind of attach to an AI server, whereas some of those traditional servers, you're talking about 2 GPUs. So their addressable market is really growing exponentially here, not only here in 2023, but over the next couple of years, we think that trend will continue as a bigger percentage of the server market becomes AI driven in nature. We've kind of seen some of the forecasts that have been driven out there by the likes of Lisa Su and Jensen Huang in terms of how big the accelerator market can be, which is really kind of the key kind of driver here on the as we kind of shift towards this more AI enabled market. And our view is this grows from a mid-30s revenue run rate in terms of accelerators to one that's going to grow north of 130 billion by 2026, 2027. So we think there's kind of real runway here to continue, not only into 2024, but even beyond there.
So Angela, massive runway for growth, but one of the limits and one of the things that we've been talking about over the last couple of weeks that's been brought up a number of times by analysts has been this expectation or question about whether or not NVIDIA is going to be able to have enough supply to meet that demand. Is that an issue? How big of a realistic issue do you see that being? Because it doesn't
given some of the yeah, you look at the guidance out there, right? I mean, it definitely seems like in Taiwan Semi out there, it's throwing some preferential treatment out there to NVIDIA. So as far as kind of being able to kind of get access to that supply, it doesn't seem like it's an enormous issue here right now. We do think that demand continues to outstrip supply, so their numbers could probably be even better than some of the numbers they are guiding to. But that's a great problem to have if you're NVIDIA, and in many respects, it's probably a good problem to have because you don't want to overheat in this market, right? The fear clearly is on the double ordering side of things, but when you kind of think about some of the big cloud providers out there and what they need to do to kind of upgrade their infrastructure, again, this isn't going to be a 1 or 2 quarter thing. This is going to be a multi-year process in terms of our view. So it is somewhat supply constrained, but we don't think it's much of an issue when you kind of look at the guidance that they've been given out there.
And so to your point about Jensen Huang talking about just this transition that companies are making, he said in the earnings report, quote, "A new computing era has begun. Companies worldwide are transitioning from general purpose to accelerated computing and generative AI." So when you think about NVIDIA and you kind of draw parallels to, say, the .com era and, who the leaders were then, who would you liken NVIDIA to, and how long do we think this runway is going to last, especially when we're starting to see a little bit of cracks when it comes to kind of some economic headwinds happening?
Yeah, so when I think of an NVIDIA, I actually compare them more along the lines of some of the bigger trillion-dollar companies you have out there, whether it be kind of an Apple and what they've done to the mobility era, what Amazon has kind of done to the e-commerce kind of era out there. And we have previously stated that NVIDIA probably going to be the most important company to civilization here, we think, over the next 5 to 10 years. Not necessarily the biggest market cap company, but the most important one out there, because they are going to drive essentially every single enterprise company out there on the planet, whether directly or indirectly, will be exposed to NVIDIA here over the next 5 to 10 years, and will significantly rely on NVIDIA to an extent. So to that extent, we would kind of compare them to the likes of an Apple, and Amazon, maybe and Netflix to what they've done on the streaming side of things. So that's how I would kind of compare NVIDIA relative to some others out there.
Angela, do you see anything stopping this massive boom in spending that we've seen in AI and the hype around it, NVIDIA being the leader, and the fact that, given the forecast, they're not seeing it slow down anytime soon? Yeah, listen, I think as far as kind of the risks out there for NVIDIA, I mean, competitive pressures are not something that we think is a major risk out there. Clearly, AMD is coming out with their kind of offering out there, and we do love kind of what AMD has the potential to do in 2024 and beyond with their MI300 chip that's going to roll out here over the next couple of quarters. Intel's got some potential out there, but nothing we're concerned about as far as kind of the NVIDIA
story is concerned. But clearly there is a cyclical risk that you always have to take into account here. There is kind of uncertainty on the China side of things. Is there some sort of ban that's on the horizon that could have a bigger impact to Nvidia's business over time? That does kind of have a potential impact to the addressable market out there for Nvidia. And then also, as things eventually start to kind of level off here, is there some sort of pricing risk out there in terms of their business? Clearly, they are pricing their GPUs at a significant premium right now. So there is going to be at some point some sort of downdraft for Nvidia, given some of the cyclical nature of this business. But that said, I mean, if you are a true long-term investor, kind of looking out over the next 3 to 5 years, we think there is considerable upside to the revenue trajectory of this company.
All right, Angelo Zeno, great to get your perspective. CFRA Research Senior Equity Analyst. Thanks.
Thanks, Emma.
Again, Nvidia, a blowout quarter here. Taking a look at the after-hours trading, we're looking at gains right now of 10%, a massive beat across the board when it comes to this quarter's numbers and also what they're forecasting for their third quarter. We're looking at a gain of just about 7% right now. Nvidia seeing third quarter revenue of $16 billion, plus or minus 2%, blowing past the street's expectations of $12.5 billion. For the most recent quarter, the second quarter revenue of $13.5 billion. The estimate was for $11 billion. That's up 101% from a year ago. Adjusted EPS $2.70, beating the street's expectations. Also, adjusted gross margin coming in better than expected. We want to break it all down with Daniel Morgan, Synovus Trust Senior Portfolio Manager. Daniel, it's great to see you again here. So
Hello.
We're seeing this reaction after hours, lots of excitement around this report. There was a heck of a lot riding on it. What's your biggest takeaway from these NVIDIA numbers?
Well, it's kind of funny coming in this report. It kind of felt like a carnival, right? I've been following NVIDIA for a very long period of time, and this is the most highly focused quarter I've ever seen. You went through the numbers earlier. There were a couple things that stood out to me. Even though the consensus on the street for their data center business was about $8 billion in revenues, they did over $10 billion. And the whisper number was 10 billion. So they beat the whisper number on the data center group. And then, of course, as you mentioned, the guidance that they gave going into their third quarter, 16 billion plus or minus 2%, way above the consensus estimate, which was at 12.5 billion. So I think overall, again, I think what this shows is that generative AI in terms of NVIDIA is for real. We're seeing a material impact on their bottom line, like we haven't really shown with a lot of other companies. And that NVIDIA is defying all odds in regards to the data center. We know that data center CapEx rates have been slowing down. Growth rates have been slowing down. We saw that with AWS up only 12% in the last quarter. We just had Snow come out earlier. They basically had good numbers, but they didn't guide up. So again, NVIDIA defying all odds, and they are definitely the poster child for AI right now.
So I want to ask, yeah, they definitely are. I mean, again, we constantly talk about how they are the leader of the pack. I mean, a huge jump in revenue, even better than expected, better than these whisper numbers that we've heard. What are you looking to hear on the call from CEO Jensen Huang, which will be coming up at about 5 p.m. Eastern?
I think the focus on the call is going to be the guidance for the third quarter. We mentioned 16 billion plus or minus 2%. There were worries coming into this quarter that their supplier, which is TSMC, Taiwan Semiconductor, may have some issues in terms of filling supply. Now, we know that the demand is there, obviously, for NVIDIA. So there'll probably be a lot of questions on the call from analysts who are going to be asking him, does he feel there's any risk with this new very high sales target in terms of the third quarter that they may have some issues filling those orders in terms of capacity, in terms of packaging. I've heard all kinds of rumors flying around of what TSMC is going to have to struggle with to get those numbers out. So I think that's what everyone's going to, be worried about, that may not materialize because of supply issues, not demand issues.
Yes, certainly we've heard that could be the one limit here to growth going forward, those supply issues. When you take a look at the reaction that we're seeing from some of the rivals, AMD, Broadcom, both of those stocks moving to the upside on the heels of these results, what does NVIDIA mean more broadly to the chip makers, other players within the AI space?
Well, it's absolutely huge. I mean, you look at the competitors, right? You've got NVIDIA has about a 70% market share. You have AMD with their MI300 chip, which they just brought out, which everybody's very excited about. You have Broadcom with their Jericho 3 that's going to come out next year. Marvell Technologies, who's going to report tomorrow night, they have their 800G PAM4 DSP chip, which they've already said is going to double revenues because of AI. So it's going to lift the whole group. There are other companies in the space that have AI offerings. Qualcomm has their AI 100. Intel has the Falcon Shore chip that comes out next year. So I would expect the NVIDIA report to lift all in the NI space, including AMD, Broadcom. I would expect to get a nice bump up on this news and so forth. And also some of the equipment makers, I would imagine, like Applied Materials and ASML, who make the equipment that go into the actual fabs.
Daniel, how does NVIDIA stay ahead of the competition? Right now, certainly they have a wide lead. What do they need to do in order to maintain that moat?
Well, they have the most amount of chips in that space. And as your other guest was mentioning, they charge a lot more than everybody else. So I think going forward with their technology and their lead ahead of the pack and the fact that they have such a wide offering, I think that's going to help them a lot, opposed to some of the other companies I mentioned may have only a single offering in the AI space. So it really comes down to NVIDIA's R&D, their ability to continue to go leaps and bounds in terms of adding new chips and continuing to offer a better chip than the competition. And up to this point, obviously, they've been able to do that.
All right, Dan Morgan, always great to get your perspective, helping us break down these numbers. Again, NVIDIA shares now up 8% in extended trading. Dan, thanks.
Thank you.
All right, Abercrombie Fitch shares soared today as its earnings smashed estimates. CEO Fran Horowitz spoke with Yahoo Finance's executive editor Brian Sozzi about the strong report and the current state of retail. Take a listen.
Big quarter out of Abercrombie & Fitch. I want to get right to really, I would say, the story of the day. That is with Fran Horowitz, the CEO of Abercrombie & Fitch. Fran, always great to get some time with you. I got this question from the Yahoo Finance community this morning. How did Abercrombie & Fitch put up this quarter? I'll put that question to you. How'd you do it?
Hey, Brian, thanks. Great to be here. So, it's interesting if you just take a step back a little bit. We have been seeing some nice progress in our business, particularly in the Abercrombie adult brands. It's our 10th consecutive quarter of growth. What we were excited to share, too, is that we saw now an inflection in Hollister and saw that coming back to growth. So the story behind the story is years of hard work, lots of transformation in the company. We've really top down and bottom up gone through every single function. We have something that we refer to as our playbook, and that's getting our product and our voice and our experience aligned for the consumer by listening to them, talking to them, going through customer insights. And that is really what we were very excited for the team to do extremely well this quarter and continue to do so. The other piece, which I know we've talked about a bit, is Chase. So the fact that we have Chase back in our business and the supply chain has eased up a bit is a big, big win for us. That's a big tool in our toolbox.
I'm not going to ask you, Fran, to critique your competitors in the mall. I'm not going to do that. But look, Foot Locker, tough quarter. Dick's Sporting Goods, tough quarter. These companies in some way are attached to the mall. Where you are, what is it about your customer base? Why are they opting for what you're selling in a very challenged consumer spending backdrop?
Yeah, my answer to that, Brian, honestly, is that in any economic cycle, there are winners and there are losers, and we are winning because we are getting our product, our voice, and our experience aligned, and they're responding to it. So the opportunity is to continue to stay close to that customer and make sure you're providing for them what they're looking for. Last Q2 in Hollister, we had a tougher time, and we stepped back and we said, how much is macro and how much do we own? And we worked on the part that we owned, and that was about our assortments and evolving them, being more than denim for back to school. What else were they looking for? Dresses. What were the wearing occasions for these kids? And that's the piece where you really just have to spend a lot of time, whether it's on social platforms, whether it's in your stores, talking to your consumers and getting those insights.
Who is coming into these stores? And let's start with the Abercrombie & Fitch brand, Fran, because it doesn't look like they're walking into Dick's Sporting Goods to buy athletic apparel. Doesn't look like they're going out necessarily and buying sneakers at Foot Locker. Macy's challenge quarter. What is that? Who is coming into Abercrombie? Is it 20 to 30-year-olds with maybe a little more money in their pocket than people think?
Yeah, I mean, the transformation of the brand, which you've been on that journey with me for quite some time, is that we've really aged up the brand. So I would say that the target, when we target a consumer from our our marketing and our design perspective and our merchants is a young millennial, so mid to late 20s. But the exciting thing about the brand is now it is such a broader range of people that are responding to it. So perhaps they start shopping with us in their 20s, they're still here in their 30s and in their 40s. So we're seeing both a broadening of categories as well as a broadening of age visiting the brand.
How are they shopping once in the Abercrombie and Fitch store? Fran, is it more casual, back to college? Is it where to office, where to work? Where are you seeing some disparities?
We're actually seeing a little bit of both. So yes, to your point, when people talk about back to school, for the Abercrombie brand, it is back to college because that's really when they start to shop with us. But we're also seeing all of the return to office. We're seeing the consumer needing a very balanced wardrobe today, Brian. They need clothes for when they are working from home, and they need clothes when they're going to the office. The exciting thing about the Abercrombie adult brand, though, is that even if they buy something from us to go to the office, they can transition that and they can go from work to weekend and to their getaways. They buy our Sloan Pant Women's, which is one of our biggest franchises today. She can wear that one way to go to the office, and then she changes her, whether it's her top or her shoes, and she goes out right after work, or she packs it up for the weekend. So it's very, very versatile.
I promise I will get to Hollister, but still on Abercrombie and Fitch, what does the cadence of this business look like for the rest of back to school? Are you seeing a good start here in August into September? And then what are some of your big bets for the holidays for Abercrombie and Fitch?
Yeah, so specifically, as you've mentioned, not a back to school brand. So we see a much more consistent business with Abercrombie than we do with Hollister. Hollister, you'll see some bigger spikes in the business with the actual back to school timing. Our expectation for holiday is that we're going in with momentum. We're going to continue to read and react to our business. As you saw today, we raised our outlook for the back half, and we're excited to have the momentum heading into the back half.
What about Hollister? So this is a more, I would say, economically challenged sector. We heard, I think, some cautious comments from Urban Outfitters when they reported. In many cases, you're operating close by in the same mall. What is the Hollister consumer doing?
Yeah, so I would say the teen consumer is definitely more pressured. That's what we started to see, last year and still seeing it today. But the consumer is shopping, and they're going to continue to shop. They're just making choices on who they're shopping with, and they're choosing our brand because we've really worked hard on evolving our assortments, staying close, understanding what those trends are for back to school. I visit stores quite often. I was in Texas for back to school a couple of weeks ago, and the energy and the excitement in the mall and in our stores was really, really exciting.
Has Hollister fully turned the corner?
I don't think there's ever a finish line. What I would tell you about this teen consumer, Brian, is they keep you on your toes. They are ever evolving. You've got to stay very close because, with TikTok and all the other things that are showing them fashion and all these trends so quickly, there really is no finish line. You've really got to continue to evolve.
Is it fair to say that in Abercrombie and Hollister, that those sales are being driven by the female business?
No, in fact, what you'll see happening, so in Abercrombie Women's, the turn did start in women's because women do shop more frequently, and we had an opportunity to speak to them and get them interested. And now our men's business is really strong. We saw double-digit increases. I think it's our third or fourth quarter of sales growth for Abercrombie men's. So we're seeing a lot of exciting things happening in that business. In Hollister, our girls' business was better than our guys' business, but our playbook will show you that it turns first in girls, and our expectation is that guys will follow.
How concerned are you about student loan repayments? We have a piece on the Yahoo Finance homepage today. A lot of retailers are calling out that as a risk to their business for the third quarter and maybe the holiday season. How do you see it within Abercrombie & Fitch?
If you've sat in this seat for the past few years, we're ready to manage anything that comes our way. I think the fact that our inventories are so lean and we're controlling what we can control, if things do happen and their consumer becomes more pressured, the best way to be is very lean in your inventories.
But you didn't factor that into your guidance. To your point, you raised guidance. You're still looking for maybe your consumer to overcome any student loan repayments. Is that right?
100%. That's exactly goes back to what I said earlier, which is that the consumer has a choice of where they're shopping. They will continue to shop, and they are choosing us because we're putting out the right brand, voice, and experience.
Do you have enough inventory? Your inventory was down 30%. Is it down in Hollister and Abercrombie and Fitch? Those are big declines. If you're seeing sales up over 20+% in Abercrombie, do you have enough stuff on the floor?
We do. And yes, specifically our Inventory is down more significantly in Hollister than it is in Abercrombie because obviously that trend was going a lot sooner than the Hollister trend was going. We have an incredible sourcing and supply chain, Brian. And now that the woes of 22 are behind us and all of those logistical issues are behind us, we are back to chasing. The team comes in on Monday morning and they're able to react to their business and we're able to turn it very, very quickly. So for us, that was a big hurt for last year, and it's a big win for us this year.
Has inflation stopped being a major problem for your business, and how do you see that playing out?
No, we're definitely still seeing inflation in the business. It's obviously subsiding a bit. Where we're really benefiting is this, again, with the supply chain and the cost of the freight going back to much more normalized rates has also been very, very helpful.
I was scrolling through your investor presentation. My old analyst self stumbled upon this. So your targets for 2025, 8 to 10% operating margin, right? This year you might be close to 10. Do you have to take those targets up?
Yeah, so that comes from our investor day that we had last June. And, when we had that day, it was pretty gutsy to do it when there was a lot of turmoil happening all around us, but it was important for us to get out there. We're not really talking about 24 and 25 yet, but certainly if the year comes in as we have projected in our outlook, we would expect to revisit those.
Lastly, Fran, 60 days ago, did you think you'd be reporting a quarter like this and actually raising guidance? To my knowledge, over the past 2 weeks, you were really the only retailer that has come out here and raised guidance.
Yes. I think that the years of this hard work and the transformation is certainly paying off, and staying close to this customer is a big win. Today on campus, honestly, Brian, it's such an amazing day for the teams to see all their hard work coming to fruition.
Fran Horowitz, I don't know how you do it, but you did it this quarter, and look forward to continuing to following your journey over to Abercrombie & Fitch. Always good to see you. Appreciate it.
Yes, you as well. Thanks, Brian. I appreciate it.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's take a look at what's trending after hours. We've got 3 names for you on the board: Nvidia, Snowflake, and Guess. Let's kick it off with Nvidia, the massive mover after hours. We're looking at shares up just about 8% in extended trading. It was a blowout quarter from the chipmaker, from guidance to what they just reported here for their second quarter. So let's break down those numbers. Nvidia is seeing third quarter sales of $16 billion, plus or minus 2%, blowing past the street's expectations for second quarter revenue. That came in $13.5 billion, up 101% from just a year ago. Profit also topping the street's expectations. Daniel Morgan telling us earlier in the hour that Nvidia is certainly defying all odds. It's a poster child for AI. Let's take a look at the recent moves in this stock chart, because you can see it really hit a bottom over the last month, just around the beginning of August. That's, of course, when there were reports, some concerns about the supply picture and whether or not Nvidia is going to be able to keep up with that demand. That, of course, is still a concern, but investors seem to be looking past that for now and taking a look at that year-to-date chart. This is a stock that's up over 220% since January 1st. Of course, we've been listening to the earnings call for the latest from Nvidia executives. But again, massive numbers, a blowout quarter from Nvidia. And we're seeing some of that reflected in its rivals, the excitement there. When you take a look at names like AMD, Broadcom, Marvell, all moving to the upside on the heels of this report. Even tech giant Microsoft, that's up just about 2% here in after hours. All right, let's flip over to Snowflake. Again, some movement there in extended trading. The company, the cloud company, reporting results. The stock now up just about 3.5%. It has been fluctuating a bit here in extended trading. Product revenue, the company seeing $670 million to $675 million. So that guidance a bit lackluster when you take into account that the street was looking for $674.9 million. But for the second quarter, revenue topping expectations, up 36% from a year ago. It's been a pretty tough environment for Snowflake. We know the company has struggled a little bit with companies trimming some of their demand for cloud spending. But again, a pretty solid quarter overall. The stock hasn't moved much since the start of the year, up just about 8.5%. And rounding it out with Guess, another read here on the consumer. The retailer popping just about 20% in extended trading. Revenue beat for the quarter. The company also raised their outlook. They see sales growth of 2.5% to 4% for the full year. Year to date, this is a stock that's still in the red, off just about 11.5%, but still the street very excited about the numbers that we just got here in extended trading, with the gains in after hours of 20%.
All right, it is closing time here on Yahoo Finance Live. Here are some of the top stories of the day. Shares of Nvidia trading higher, up around 8% after hours after a massive beat on the top and bottom line. Revenue coming in at $13.5 billion compared to the street's estimate of $11 billion. Adjusted earnings per share, $2.70 compared to the estimate of $2.07. Now, data center revenue hitting a record $10.3 billion, up 141% since the first quarter. Guidance for Q3 revenue also beating estimates. Investors certainly over the moon about this report. Speaking of which, India successfully landing a spacecraft on the moon's south pole today. Now, India is the first country to land on that part of the moon. The success comes just days after Russia attempted a similar mission, but its spacecraft crashed into the moon's surface. Back on Earth in Hollywood, we're getting new details about the progress of strike negotiations. The Alliance of Motion Picture and Television Producers releasing the terms of its most recent proposal to the WGA to the public. The Writers Guild has denied the proposal. And 10 people have reportedly died in a plane crash just north of Moscow. The Russian Federal Air Transport Agency has confirmed Yevgeny Prigozhin was on board the plane. Prigozhin was the leader of an unofficial military party called the Wagner Group, which led a failed insurrection against Russia's leadership back in June.
And here's what to watch on Thursday. We'll be getting a read on weekly jobless claims. They're out at 8:30 a.m. Eastern time. The Fed will be keeping a close eye on those results here ahead of the Jackson Hole Economic Symposium that gets underway. While markets wait for Fed Chair Jerome Powell on Friday, we will hear directly from Boston Fed President Susan Collins on Yahoo Finance Live, 11 a.m. Eastern time. And investors will get a fresh batch of retail earnings. Dollar Tree reports ahead of the open. After the close, Nordstrom, Gap, and Ulta. Wall Street is predicting Nordstrom will see revenue decline, and the concern is whether or not they will face similar pressures to some of their rivals. Macy's just warning that consumers are becoming more cautious. And for Gap, the focus will be on the company's new CEO, Richard Dixon, who took over this week. He's been credited with the turnaround for the Barbie brand at Mattel, so there's hope that he can do something similar for Gap. We'll also get more on the tech earnings after the close with numbers from Marvell Technology, Workday, and Affirm. And on the heels of the first Republican debate, a sit-down interview with Tucker Carlson, former President Donald Trump has said that he plans to voluntarily surrender to Fulton County Jail in Georgia. The former president facing 13 felony counts for allegedly trying to overturn the state's 2020 presidential election result. Well, that does it for us today on Yahoo Finance Live. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a good night.